One of my favorite things to do as a financial planner is helping people with giving strategies. Giving is very important for a fulfilling life. It sort of opens up the veins and opens up the arteries of your life in a spiritual sense that allows you to be a more generous person. Typically people who are givers are more successful overall, not just financially, but also in terms of life goals and family. And so one of the things that we really encourage people to try to do is to incorporate giving into their lives. Now, some people from a spiritual standpoint find it an important spiritual discipline, for example, tithing to your local church. But even if that's not something that's important to you, we would encourage you to think about giving to something in some way and to really take ownership of that. It doesn't need to be a lot of money, but we do want you to think about that. Now, giving in and of itself is a great thing and should be done, but it's also great when we can time it up with tax saving strategies. And you shouldn't necessarily do giving just to save money on taxes, but if we can do that, it's really helpful and it overall improves your financial picture. It's like a little reward. Now, in the past, the standard deduction in taxes used to be a lot lower. And actually in 2017, 2018, when the new Tax Cuts and Jobs Act came into effect, it raised the standard deduction significantly. And so this helped a lot of families actually overall. It was a good thing. But for a lot of people in this area of Northern Virginia, especially ones that are doing giving on an ongoing basis, like tithing to their church or giving to organizations that support people who are in need, and take that very seriously. If you don't have specific strategies in place, you're leaving some tax savings on the table. We're going to talk about 5 of those strategies today. So the first one, of course, is just direct giving. Okay, now, unless you itemize your deductions on your taxes, you're not getting any benefit from a tax saving standpoint for giving. And so you need to itemize. And the 3 big things that you itemize and affects most people in this area when they're considering this strategy is state and local taxes, that's capped at $10,000. There's charitable giving, and then there's your mortgage interest. And so when you add all of that up in a given year, if it's more than the standard deduction, which for a married filing jointly couple for 2023 is $27,700. If you're single, it's $13,850 for 2023. That's going to go up in 2024, by the way. What that's going to do is when that's above the standard deduction, you add all those up, and then that's how much you deduct off of your taxes as the primary below the line deduction from your AGI to get to your taxable income. Now, that's great, but here's the thing. If you're giving consistently, and let's say you're just above the standard deduction, so the standard deduction for married filing jointly couple is $27,700. If you add up those itemized deductions that I talked about, by the way, there's more, but the 3 I talked about, those are the big 3. If that's higher, let's say it's $28,000 or $29,000, yes, that's good for your tax situation, but you're kind of leaving some of that giving on the table because some of that giving had to be utilized to get to the $27,700. So you're leaving some of that on the table. So that gets into strategy number 2, which is called the deduction maximization strategy. The deduction maximization strategy is if you're, let's say, giving consistently, let's say you have state and local taxes of $10,000, your mortgage interest is $5,000, $6,000, $7,000 a year, and then your charitable giving is $10,000 a year. You're sort of right in that standard deduction threshold. But if we can, let's say, take the giving that you would do in the future year and do that right in December of this year, you basically get to have a larger itemized deduction. So that same example, let's say that $10,000 that you would have put in 2024, if you can do that giving in December 2023, it goes on your 2023 taxes, and then your itemized deductions are much higher than your standard deduction. And that could be a really great strategy for you because you then end up doing a larger itemized deduction in 2023, and then in 2024, you're going to take the standard deduction. And then in 2025, you're going to end up doing more of that giving, and you kind of hop back and forth between itemizing and doing a lot of giving in one year, and then doing no giving calendar year wise in the next year and taking the standard deduction, and then kind of alternating back and forth. Now, for some people, this can be really helpful, but there's also a spiritual component for many of our clients that they want to be giving consistently over time. And when they do that, one way to allow that to happen, and let's say they're supporting a church or if you're supporting a charity that's relying on your income, you might want to make sure that those monthly contributions don't stop in the off years where you take the standard deduction. And so to do that, you could use what's called a donor advised fund, or I'm going to use the word DAF, D-A-F for short, when I talk about it. So a DAF, basically, when you do that giving at the end of 2023, you're going to take all that money that you would do, and you're not going to give it right to the charity or the church or the mosque that you would be giving to, but instead, you are going to put that money into a donor advised fund, a DAF. And you're going to then instruct that DAF to give out monthly payments over the next year. But by doing that giving at the end of 2023 into the DAF, you get that charitable deduction in your to make higher itemized deductions overall in this calendar year. So that's another thing that could be really helpful for you is the DAF. Now, DAFs are also helpful if, let's say, you have a big windfall. So let's say you sell a business and you have $1 million coming in, and for one given year, you're in the highest tax brackets. You're trying to figure out, how do you save money on this? Well, if you are a giver and if there is giving places that are important to you, but you don't know exactly where you want to give it, and let's say the windfall happens in October, November of the current tax year, well, what you can do is you can take the amount of money that you would end up giving, put into the DAF, get the charitable deduction this year to save money on taxes because you're at the very high tax bracket, and then you can instruct the DAF, you have 5 years, as to where to send the money over time. So that's another way that the DAF can be really helpful. The fourth strategy is if you have appreciated stock. We actually have clients that bought tech stock years ago and it's appreciated substantially. And so there's money sitting in their joint accounts, or I should say stock sitting in their joint accounts that has big appreciation on it. And so if they were to sell that stock and use that money, they're gonna have to recognize a capital gain on the difference between how much they paid for it and how much it's worth when they sell it. And if you end up giving to charity, or you can actually donate that stock to charity, what ends up happening is that gain, you don't pay taxes on it, but you get the full fair market value of the amount that when you donate. So it's a great way to get a high donation amount without paying taxes on any gains that are there. This is only really applicable if you have joint investment accounts or individual investment accounts. It doesn't work giving out of IRAs in this way. Well, speaking of IRAs, here's the fifth strategy: qualified charitable distributions. This comes out of your IRA or 401k, and here's how it works. When you reach the age of 70 and a half, money can go directly from your IRA over to a charity, and it has great tax benefits that I'll explain in a second. So if you're a giver and you give consistently, and usually you might think, oh, I'm writing a check from my bank account that goes directly over to the charity. That's great, okay? Now, if you're taking the standard deduction, you're not really getting the benefit of that giving from a tax saving standpoint. Now, we talked about the deduction maximization strategy, and that's something you can do, but QCDs are actually even better than the deduction maximization strategy. So when you're doing that direct giving from your bank account over to the charity, you might not be getting a tax write-off if you're taking the standard deduction. But if you give directly from the IRA over to the charity, so not necessarily being distributed, this is called a qualified charitable distribution. And it allows you to satisfy the RMD requirement, number one. And number two, you don't recognize any of that income that goes from your IRA directly over to the charity. And so basically what this allows you to do is take a tax benefit or a tax deduction for the charitable giving and also take the standard deduction.